I think the best way to get superior returns, 100x type returns, if you're an individual, would be you adopt, you keep your day job, and so you maximize the cash flow you generate via whatever your profession is. You're responsible on your expenditures. You have to think in the year 2045, I think a Bitcoin's worth $13 million. So every Bitcoin that you don't buy is a $13 million cost. That Ferrari that you're going to buy is going to cost you like 6 Bitcoin. And so it's going to be $100 million Ferrari, right? If you look out 20 years. You have to keep your job. Unless you're insanely rich, don't splurge on the Ferrari. Buy the 6 Bitcoin instead. Well, we've got haves and have-nots. CNBC talks about 100 tickers a day, but there's 100 stock tickers total, and they make up 80% of the trading volume. There's 12,000 public companies in the US. There's 4,000 or 5,000 on NASDAQ and New York Stock Exchange. Most of them, the market has lost interest in, and they're competing against a Google or against Amazon or against a Microsoft or against an Apple. So if you're one of those mid-sized small companies and you're staring at these trillion-dollar, digital giants, and no one cares about you, then at some point after struggling like that for month after month, year after year, you start thinking it's kind of hopeless. And so the explosion in interest in Bitcoin treasury strategies, I think, comes because companies are realizing that there's hope for them. There's an opportunity. And it is by plugging into the next great digital transformation, right? The way that you actually get back on top, the way you start re-energizing a company and growing it, is by digitally transforming your balance sheet. And the companies that have done it earliest are having extraordinary success. Companies like Strategy, companies like Meta Planet. And so as more and more companies embrace the Bitcoin standard, and as their stocks start to perform and as their investors start to see success, the idea is spreading because, no one takes a company public wanting to be an also-ran or be roadkill for Amazon.
Why do so many companies resort to things like stock buybacks or acquiring other companies when they're deploying capital? Why not buy Bitcoin?
The conventional corporate finance playbook is cash is trash and cash underperforms the S&P index. And so the S&P index is the cost of capital. And if you've got excess cash flow, then you need to return it to the investors so they can invest it and get that cost of capital or get the S&P return. And you either do it with a buyback or you do it with a dividend. I think the primary reason the market concluded that is because for 100 years, the treasury reserve asset of every public company was short-dated treasury bills. And they never had another treasury asset. Your choices would be treasury bills, gold, or Bitcoin. Gold was the reserve asset of the 19th century. Corporate or sovereign debt, like 30-day T-bills, is the treasury asset, the reserve asset of the 20th century. And Bitcoin is the reserve asset emerging in the 21st century.
But for the average person watching who's probably a wage earner and not a business leader, what do you think is the best way to 100x your money? Can you still do it with Bitcoin, and what types of strategies can be deployed?
I think the best way to get superior returns, 100x type returns, if you're an individual, would be you keep your day job, and so you maximize the cash flow you generate via whatever your profession is. You're responsible on your expenditures. You have to think in the year 2045, I think a Bitcoin's worth $13 million. So every Bitcoin that you don't buy is a $13 million cost. That Ferrari that you're going to buy is going to cost you like 6 Bitcoin. And so it's going to be $100 million Ferrari, right? If you look out 20 years. You have to keep your job. Unless you're insanely rich, don't splurge on the Ferrari. Buy the 6 Bitcoin instead. With regard to leverage, The intelligent leverage for the individual is generally long dated, mid dated mortgage debt. So if I have any kind of property, if I have a house, I would put a long mortgage on it, a 10-year mortgage, a 15 to 20-year mortgage on it, especially a conforming loan. And then I would roll it into Bitcoin because mortgage debt is not mark to market. It's against an asset which is fairly stable. Normally the interest rates are somewhat subsidized by a Fannie Mae or a Freddie Mac program or a government program. So it's the cheapest form of permanent capital that someone can get. So, I give you what you shouldn't do. You shouldn't quit your job. You shouldn't splurge on sports cars you can't afford. Don't buy a yacht because it's obscenely expensive, and don't pay off your mortgages. Don't get debt free. Any capital you have that's not marked to market capital would be better invested in an asset that's going up 30% a year for the next 20 years. All of these actions are creating uncertainty in the market, right? Trade uncertainty, operational uncertainty. How do I organize my supply chain? What products should I stock on my shelves? What products should I buy? How long will it take? What services do I need? Where do I source the services? That uncertainty creates massive inefficiency. It creates dislocation. Investors are discounting the future cash flows for the next 10 years of a given business. And so if it's uncertain whether the business will exist and in what form and how profitable it'll be, then they tend to shoot first, ask questions later, or in this case, sell first, ask questions later. Their view would be, let's just back away from the market until it becomes less uncertain. That's what is driving the macroeconomic headwind right now. Whenever a company runs into a difficult time like that, whether it's COVID or whether it's the current, tariff wars, it behooves the company to be extremely well capitalized. What you would like is to have a company that has a deep, deep pool of liquid assets you can rely upon, even if your core business revenues get zeroed out. If you don't have that, you're going to go bankrupt in a prolonged crisis. Herein lies the solution, the promise of Bitcoin, and the problem with traditional corporate finance. Traditional corporate finance teaches these companies to decapitalize. So they've all been decapitalizing. They've been surrendering their capital via buybacks and dividends. So when they're not well capitalized, and they run into economic uncertainty in their operating business, that creates extreme anxiety for the employees, the executives, the customers, and the investors. The promise of Bitcoin and the Bitcoin standard is that every company can be well capitalized. Because if you simply start sweeping your cash flows into Bitcoin, or you convert your dividend into a Bitcoin buy, or if you convert your buyback of stock into a buyback of Bitcoin, then your enterprise value over time would double. And your organization would be valued partially on future expectations, but partially on the assets you own. And so you can imagine when 95% of the value is future expectations. When they become uncertain, 95% of the value becomes uncertain. But when half the value of a company is based upon the assets they own, right, then they have a built-in insurance policy or a shock absorber, and they have the luxury of being able to sit back and see how things work out, but without being desperate or taking short-term actions. Bitcoin offers one more collateral advantage, which is the more uncertain the operating world gets, the more valuable Bitcoin becomes and the more compelling the idea is, because there are no tariffs on Bitcoin. Bitcoin doesn't have supply chains. It doesn't have all of the regulatory risk, the tax risk, the operating and the execution risk that you have when you have a business based upon providing products and services in a particular way. Every single crisis recruits a new class of Bitcoin believers. There's just a delay in between the crisis and the Bitcoin rally. So, for example, in March, Bitcoin crashed with everything else down to like 4,000 or 4,500. And I started buying it in the 9,000s or the 10,000s. And I remember when Bitcoin was 10,000 and the NASDAQ was like 12,000. And, then Bitcoin would rally up and rage, and then there would be a crypto crash and it came down. On the other hand, here we are today, Bitcoin's like 96 or 97,000, the NASDAQ 17,000. And now we're in a big tariff crisis. And the near-term reaction is always the market cramps and everybody sells everything. But the long-term reaction is, if I had all my money invested in Bitcoin instead of invested in that company, I wouldn't have been affected by tariffs. And so what you have is a reallocation of portfolios to being more Bitcoin, less the other thing. People are thinking now, if I had more Bitcoin, less gold, I would have made a lot more money in the last 4 years. If I had more Bitcoin, less big tech, I would have made a lot more money. If I had more Bitcoin and less that bond instrument, I would have done better. So these are teaching moments, right? And in any macro panic, the most liquid, leverageable asset is Bitcoin. Bitcoin is the only thing that you can sell. You can sell it short with 50x leverage on Saturday morning. It's the only thing that you can short 50x on Saturday morning. So when people panic on a weekend or an evening, it's going to be volatile. And if someone wants to sell some financial asset because of some gloom and doom thing that's happened, they're going to go to Bitcoin first because it's the only thing they can trade. And not just trade in the US, trade globally, worldwide. It is volatile because it is useful, and it will be in times of panic and contraction. It will correlate for a short moment with other assets, but then it will bounce back and it will it'll break that correlation, decouple, and it'll rally higher. And that has happened, consistently for the past 15 years, and it's happening right now as we watch it. So I'm calm in these times because I think we're going to win over a new set of Bitcoin believers, and a new set of people that thought they had the perfect business are going to realize that no investment in real estate and private equity and public equity or in a currency derivative is a risk-free investment. And when we say, look, Bitcoin is not a currency derivative, it is not a company, it is not real estate, it doesn't have a supply chain, it has no employees, it has no nexus, it is not, subject to that counterparty risk. Now there'll be a new class of investors that will understand what it means to be exposed to those risks, and they'll be like, oh, you mean like no tariffs on Bitcoin? Mm-hmm. Yeah, no tariffs on Bitcoin.
Welcome back to the Market Chronicles. This is episode 19, and today we're doing a deep dive into some pretty interesting recent comments from Michael Saylor.
Absolutely. He's got strong views on Bitcoin, of course, but also on broader corporate strategy and, importantly, what individuals should consider.
Exactly. And for those of you tuning in on YouTube, make sure you hit that subscribe button so you don't miss out on future analyses like this one.
We've been looking at an audio recording of Saylor laying out his thoughts.
Right. And our goal here is really to pull out the key insights, understand his perspective on how to navigate, the current market environment.
So let's start with individuals. He talks about getting those like 100x type returns. What's his advice there?
Well, the core strategy, it sounds pretty straightforward initially. Maximize income from your job, your main hustle, and keep a really tight rein on expenses.
Standard financial advice, almost.
Mm-hmm.
But then it connects to Bitcoin.
It does, because that saved capital, that's what you potentially use. And it's tied to a very, very long-term view. He throws out a figure like $13 million per Bitcoin by 2045.
Wow. Okay, $13 million. That definitely reframes things.
Doesn't it? He uses this example like a Ferrari in the future might cost 6 Bitcoin.
Which, at that projected value, is $100 million.
Exactly. So his point is, unless you're, as he puts it, insanely rich already, accumulating Bitcoin should probably come before the Ferrari.
Right. Delay gratification, focus on the asset accumulation.
Yeah.
Makes sense with that kind of projection.
And he has a specific tactic, too, using long-dated mortgage debt. Basically lounging cheap, non-market-to-market capital to buy Bitcoin.
Okay, so using your house potentially as leverage, but in a structured way.
Seems like it. And conversely, he warns against things like quitting your job prematurely, spending wildly on things you can't afford,
Uh-huh.
or even paying off low-interest mortgages too quickly if that capital could be better used, in his view, to buy Bitcoin.
So it's about being strategic with your capital flows, prioritizing Bitcoin investment.
That's the core idea, yeah. Stable capital into a high-growth potential asset.
Okay. So what about companies? He also talks about corporate strategy, especially for maybe smaller public companies.
He does. He paints this picture of mid-sized or smaller firms feeling kind of hopeless, competing against the trillion-dollar tech giant.
Tough spot to be in, for sure.
Yeah, and he suggests this feeling is actually pushing them to look at Bitcoin treasury strategies more seriously.
Ah, so Bitcoin is a potential lifeline or differentiator.
He frames it as the next great digital transformation, not just for operations, but for the balance sheet itself, a way to, re-energize the company.
Interesting. And he points to examples.
He mentions his own company, MicroStrategy, and also MetaPlanet, citing their, quote, extraordinary success as early adopters.
Right. The proof of concept argument. Seeing others succeed makes it more palatable.
Exactly. The expectation being that more companies might adopt this Bitcoin standard, as he calls it, seeing positive results and investor interest.
And how does this contrast with, say, traditional uses of capital, like buybacks?
Well, he contrasts it directly. The conventional view is often cash is trash, get it deployed, maybe benchmark against the S&P 500 cost of capital, buy back stock, make acquisitions.
Standard corporate finance playbook.
Right. But Saylor positions Bitcoin differently. He puts it in historical context. T-bills were the 20th century reserve asset, gold the 19th.
And Bitcoin is the 21st century digital equivalent.
That's his argument, the emerging reserve asset for corporations.
Okay, let's shift to the macro picture then.
Yeah.
How does all this fit into, the broader economic uncertainty we see? Trade issues, operational hurdles.
Yeah, he talks about how that uncertainty creates inefficiency, investors get cautious, they discount future cash flows more heavily.
Which makes being well capitalized really important, right? Having that buffer.
Absolutely. Think COVID, tariff wars, companies with strong balance sheets navigated better. He argues that traditional finance often decapitalizes companies through buybacks and dividends, leaving them vulnerable.
So Bitcoin becomes a tool to recapitalize.
That's the idea. Instead of just returning cash to shareholders or holding cash, allocate cash flow to Bitcoin or convert planned buybacks into Bitcoin purchases, strengthen the balance sheet that way.
And the benefit there is.
Well, part of the company's enterprise value then rests on an owned asset, Bitcoin, which acts as a kind of shock absorber. When things get uncertain, that asset base provides stability.
And he argues Bitcoin has a unique advantage here.
Yes, because its value, he believes, can actually increase with operating world uncertainty. Why? Because Bitcoin doesn't have tariffs, doesn't rely on physical supply chains, isn't tied to a specific country's operational risks in the same way.
So global turmoil might actually drive capital towards Bitcoin.
That's the thesis. He sees crises as catalysts for adoption, though maybe with a bit of a lag.
Any examples he gives?
He mentions Bitcoin's recovery after the March 2020 crash and its performance during more recent tariff situations. The idea is investors start reallocating.
Moving away from, say, gold, big tech, maybe bonds, towards Bitcoin as they see how it performs in these stressed environments.
Precisely. And he emphasizes its liquidity and leverageability, even during panics. It trades 247 globally, weekends included.
Which makes it useful in a crisis, but probably also contributes to its volatility.
Exactly. He acknowledges the volatility, but sees it as a feature of its utility during panic. Then he expects it to decouple and rally afterwards.
And underlying all this is the idea that maybe no traditional investment is truly risk-free anymore.
Right. He stresses Bitcoin is different, not a currency derivative, not a company stock, not real estate, fewer counterparty risks. His line, no tariffs on Bitcoin, kind of sums up that unique positioning.
Okay, so pulling it all together, Saylor's view is quite comprehensive. It's Bitcoin for individual wealth building through discipline and maybe leverage.
Yep, long-term focus.
And Bitcoin as a strategic corporate treasury asset, especially useful in uncertain times, offering a way to capitalize and potentially outperform.
It really forces you to think about the long term and how the very nature of what constitutes a reserve asset might be changing.
Definitely. Which leaves us and you, the listener, with a pretty big question to ponder. If more individuals and more companies start integrating Bitcoin like this, how does that ultimately reshape finance and maybe even the global economy?
Something to definitely keep thinking about. Thanks for joining us on the Market Chronicles for this deep dive.